Hello, friends. October 26, 2024. Let's talk about momentum monkeys. Lovely animals. They have also been some of the best stock market investors. Let's see why this is the case. Let me add my screen here. Okay, these are the momentum monkeys. They throw darts on stock quotes as was first described in the book A Random Walk Down Wall Street, and they invest. And overall, they have done better than most investors and fund managers. Disclaimer, there is no investment advice in this video. And all content within this presentation constitutes the author's own opinions. Please read the rest. So what do we have here? Here we have a very simple long-only momentum strategy. We're going to talk about long-only momentum because that's popular with traders and investors. This strategy trades the top S&P 500 index stocks as follows. At the end of every month, we rank all the stocks according to the 120-day rate of change. So we look at the performance of this, of all the stocks in the index at that time. In the past 120 days, about half a year. And then we take the top 10 stocks, we invest in those stocks. And from 1988 to the end of 1999, this is how the strategy worked. This is the equity is the green line here, green area. And we used S&P 500 index series that include past and present constituents to avoid survivorship bias. These series are offered by Norgate data. They are very useful to assess the performance of momentum systems and also many other types of systems in the past, survivorship free. So the green line is the equity and the red line is the S&P 500 total return. And we see that the annualized return was 17.4%, and Sharpe ratio was 0.79. So although the strategy underperformed the S&P 500 total return, however, it had a significant annualized return and looks pretty good. But is it really? Is it really good? Well, let's see what happened after 1999. After 1999, the same simple momentum strategy had the annualized return of 9.3%, and the drawdown, the maximum drawdown increased to 62.2%, and the Sharpe ratio dropped to 0.35. So after 2000, volatility increased to 26.8%. And the strategy, although it outperformed uh, the S&P 500 total return, which is the red line on this chart, however, volatility increased to the point that this strategy was not tradable, basically. So, and as you see, the returns after 2014 were very small. Now let's see for the whole period. For the whole period, the return was about 11%. Maximum drawdown was about 64%. And the Sharpe ratio was 0.43. Really disappointing. And the performance as compared to S&P 500 total return has been about the same. And the index, the total return index, has even a lower maximum drawdown and higher Sharpe ratio. So what happened? You see what happened here. Momentum was really good in the 90s, but then long only momentum with top 10 stocks. But then volatility increased significantly. Why did this happen? Maybe the strategy got very crowded, or there was a momentum regime change. We can never know what happened. So this is the performance from 1998 to 2024, October 22, 2024. So what we have done here, we called 500 momentum monkeys. What do we mean by this? Instead of taking the 10 top stocks with highest 120-day rate of change at the end of each month, we randomized both the stocks we take, we consider, and also the rank. So this is how this works. These 500 monkeys, they tossed coins, and for instance, they consider a stock if the coin outcome was heads. So immediately half of the stocks were not considered. Plus the rank, they took a random rank. They didn't take the stock with the highest momentum rank. And different monkeys had different performance. The performance varied from about 4.75, the annualized return in this period, 1988 to October 22, 2024, from 4.75, the annualized return, to about 16.75%. So there is a distribution. This distribution is maybe close to normal. Who knows? We're not going to get into this. And the mean is 11.5%. This is important because it means that the 11% of the strategy is even lower than the mean. Or if you count and you rank the strategy, 61% of the monkeys did better than the strategy. So we have verified for this particular strategy the random walk theory, that throwing darts on stock quotes is better, has been better than a momentum strategy. But that was only one momentum strategy. What about another momentum strategy? Well, first of all, if we think there is a general rule that momentum performs better than random trading, then we have falsified because we found an example. It doesn't work. But let's try another strategy. In this strategy, we introduce price series momentum. It's the same strategy as before, but at the end of each month, we look at the 12-month performance of a stock, plus we want the price to be above the 12-month moving average. So we rank the stocks according to the 12-month rate of change, and then we also make sure that the price is above the 12-month moving average. So, and we take the top 20 stocks. So this has been even better, 13.67%, and the Sharpe ratio is 0.61. The drawdown is still high, very high, 62.7%. So this is not bad. This particular momentum with price series added, did well, actually very well in the 90s, in the 80s and 90s, and then the performance started becoming volatile until QE3. QE3 started in 2013. So this ranks at about 89%. So in other words, 11% of the monkeys have done better even than the strategy. Even than the strategy. What about if we change the period of the strategy from 3 months to 24 months, the period we use in the moving average and also for the ranking? We see here for 12 months, it's the result we had. And for 3 months is the highest annualized return, but still at a very high drawdown. And then we see something peculiar. For 4 months, the annualized return drops by 400 basis points. So there is some kind of curve fitting or randomness in the performance of momentum, maybe from 7 months to about 12 months, there is a quasi-stable range for the annualized return, but the drawdown levels are still so high, the strategy is not tradable. So traders and systems developers, what they do, they add new conditions, like we want the S&P 500 to be above the price, above the 200-day moving average, and maybe some volatility filters, and all those increase the parameter space, the free parameter space, and the possibility of overfitting. So the strategies, they start diverging from pure momentum and they become something else. uh, probably something that cannot be precisely understood or described. It's highly nonlinear and it's very sensitive to regime changes. So, due to hindsight bias, uh, they adjust the parameters instead of a 120-day uh, rank function, rate of change. They take 252 days or 60 days. They try to smooth the performance, but this is hindsight. This is data snooping, data mining bias, and it doesn't improve anything. It just makes the strategies more sensitive to regime changes, and they can suddenly lose lots of money. And the momentum monkeys, they will always, on average, outperform those strategies and the traders and fund managers who are using them. So this is the story about the momentum monkeys. You can, if you have the data or you can get access to the data, you can do your own tests and randomizations of the entry, exit point rules and everything else. Try to find out yourselves how these strategies perform and how do they rank under stochastic modeling conditions. And I think it's a useful exercise to get familiar with some ideas that I think they have survived because in the past they worked, but nowadays they are very questionable. Momentum is a very tricky concept. Long or short momentum is another chapter. Long short momentum hasn't worked very well after the .com. However, long short momentum has very low correlation with the market and can be used for convexity purposes in a portfolio allocation, but at the expense of some significant impact on annualized return and total return. And maybe in some other video I will show some examples. I have some articles, my blog about long short momentum. And also the difference between pure momentum, like the rate of change, and price series momentum, like moving averages. That's another interesting subject. And you can study this, but you need, for the stock market, you will need a price series with past constituents and delistings, as they call them. And I used to Northgate data price series. They are very clean and robust for this, for my studies and my strategies. So have a nice day. Thank you for watching.